To do the job right, you need the right tools, and that's especially true when the job is your retirement. Hi everyone, I'm David Scranton, and thanks for joining me on The Income Generation. You know, somewhere in your house, there's probably a toolbox. And it almost certainly contains a lot of the same tools that are in my toolbox. But if you're a professional plumber or a professional electrician, you likely have another toolbox, one that's filled with thingamajigs that I wouldn't even recognize. And today we're going to talk about the thingamajigs in the toolbox of an advisor who specializes in income. And we're calling this episode, Understanding Your Retirement Income Options. And specifically, we'll be covering the classic income tools that everyone knows about, as well as some of the less well-known options. Also, why the right strategy is as important as the right tool. And finally, how to determine which options are right for you. Helping me out as usual is income specialist and best-selling author Jeff Small. We'll also hear from our special guest, economist and market forecaster, Dr. Marc Faber. We'll also hear from income specialist Joann Regan and Anthony Saccaro. And first, let's talk about the income options that you probably are already familiar with. Boring and old-fashioned, as I called them in my first book. Those are terms that I've used to describe, really over the last decade or more, some of the best-known tools in income specialist toolbox. And I say old-fashioned because there's a time when these tools were preferred by Americans and they actually worked. And in some ways they were hip. And these would be some of the most conservative options in the toolbox. Things like bank CDs, government bonds, perhaps even insured municipal bonds, or fixed annuities. In fact, the hipness factor for these existed in the 60s and in the 70s, and then they began to fade in the 1980s when the whole retirement savings game started changing. Pension plans, the traditional ones at least, were disappearing, and they were being replaced with 401k plans. Then, of course, the 1980s, like we talked about, and the 90s. The long and perhaps the biggest bull market we've had in the stock market ever. And it simply made Wall Street the hippest option of all. And frankly, that really hasn't changed much to this day. In fact, the stock market's become even more popular in recent years due to consistently low interest rates since the financial crisis. And the reason for that is because low interest rates typically push everyday investors up the risk curve by making people think that traditional income-based options are less attractive. Low interest rates can also create challenges for the most conservative income tools, namely bank CDs and government bonds. And the good news is that these challenges can be minimized in a diversified, actively managed income portfolio. So what about fixed annuities? Well, as you know, an annuity is a financial contract between you and an insurance company. A fixed annuity is designed to generate interest based upon a minimum interest rate for the life of the contract. Market changes may force the insurance company to raise or to lower the rate, but if you're taking income, that won't affect your income return. Now, while these tools are all still viable, the more important point is that the options offered by today's income specialists are more numerous and diverse than those used by our parents or grandparents. And today, investing for income encompasses a wide range of tools and a wide range of strategies to suit your situation and your risk tolerance level, something we'll be talking about in just a moment. But before I welcome Jeff, let me take a moment to answer one of your questions. Tony from Rhode Island asks, what are the main differences between municipal and government bonds? Well, government bonds are issued by the federal government. Municipalities are issued by states or towns, typically, or by certain projects that are run by states or towns. The biggest differences are in risk and taxes. So obviously, in theory, the federal government can't default on its debt on a bond because they can just print more money, whereas states and municipalities can't do that. So they can default. Although it's not common, they can default. The other difference is taxes. It's called the reciprocal law of immunity. So if you own a U.S. government bond, you don't have to pay any state income taxes on that bond, the interest from that bond, but you do have to pay federal income taxes. If you own a municipal bond, then you don't have to pay any federal income tax, but you do have to pay state income taxes on the bond. However, if you own a municipal bond from the state in which you live, then you pay no state income taxes or federal income taxes. So the taxes become a great motivator there. Tony, great question. Thank you. And be sure to send me your questions by emailing us at askdave@theretirementincomeStore.com. And now, Jeff, we're here today to talk about this, one of our favorite topics, and of course, that's retirement income planning.
Retirement income planning. I remember the good old days, Dave, when you could get 5% in a CD. But we haven't seen that really since the prior to the financial crisis of 08-09. So folks have been scrambling for yield ever since, and our business and income modeling and fixed income specialization as income specialist has boomed.
It's interesting you say your timing's perfect. 2006, I remember putting clients in CDs at about 5.25%, maybe the beginning of 2007, and then everything fell apart, and you're right, they just haven't been the same ever since.
No, they haven't. So folks have been scrambling for how can we get yield with safety and stay in that conservative realm. And one of the ways folks can do that is through annuities, which in general get a really bad rap. Most investment advisors, financial planners, financial advisors don't understand the annuity they're recommending. They don't understand how it should be utilized and what the benefits are. But there are annuities out there that you can harvest a 3, 4, even a 5% average yield from over the long term, whether it's tied to the market or tied through fixed interest earnings like a CD.
Yeah, I always say annuities are like the good, the bad, and the ugly, right? You ask 10 different people, you get 10 different opinions. The bad rap on annuities, most of it is variable annuities, I believe, because the fees are very high. But those are in the market, so those have more risk. And the other thing is immediate annuities that are totally inflexible, that when you put your money in, you can never get it back. And Jeff, of course, I know you're not talking about those types of annuities.
No, never would I talk about those types of annuities, Dave. I mean, seriously.
Yeah.
But variable annuities are probably the worst investment ever invented. If you own one of those things, you probably need to find a way to get out of it. But first you got to understand how it works, what your fees are, what your riders are, exactly what you're paying for, because there's 3 to 4 layers of fees and those types of vehicles. And the average charge collectively is around 3.5%.
And government bonds this year have been bad too. I mean, with interest rates having gone up since the beginning of the year, the average person with a 10-year government bond lost 7% so far year to date. So even government bonds, really haven't made a great conservative option. So alternatives, of course, Jeff, we'll be talking about in just a minute. And coming up, we'll be talking to economist and market forecaster, Dr. Marc Faber. But first, we'll talk more about some of these other options available in an income specialist toolkit. All this and lots more coming up on the Income Generation.
Are you truly ready to retire? Do you have the right strategy to pay for your lifestyle for the next 30 years or more? Take our free retirement readiness quiz at areyoureadyforretirement.com and discover what your retirement strategy may be missing. Don't let market volatility derail your retirement plan. Make sure you're fully prepared by learning about hidden risks to your retirement. Visit areyoureadyforretirement.com and take our free retirement readiness quiz.
Welcome back to the Income Generation. I'm David Scranton, and today we're helping you understand your retirement income options. And so far, we've covered what I like to call the dull, boring, and old-fashioned, but still useful, conservative options. But now let's look at some that are a little bit less conservative and perhaps even a little bit sexier. Investment-grade corporate bonds, maybe slightly below investment-grade corporate bonds. Indexed annuities, investment-grade preferred stock. These are some of the tools that we might categorize as being more moderate risk. And that means they may carry moderately more risk than the conservative options. Take investment-grade corporate bonds, for example. Like government bonds, like municipal bonds, they can fluctuate in value depending upon interest rates. Importantly, though, it must be the interest rate commensurate with the class of bond that you own. This fact creates something called credit spread compression and expansion. The compression side can actually help minimize the impact of rising interest rates on income portfolios that are in corporate bonds instead of government bonds, something we'll talk about coming up in a bit. More importantly, investment-grade corporate bonds also generate income at a fixed rate of return regardless of market conditions. And the corporations guarantee your return of principal if you hold the bond to maturity. And of course, provided the corporation doesn't default on its debt. And it's that risk, the risk of default, that makes corporate bonds really riskier than government or even municipal bonds. Because like all conservative income tools, most of those in the moderate category are contract-based. This includes preferred stocks. And yes, even though a preferred is a share of stock, it pays income return at a fixed dividend rate. And like a corporate bond, it also has a par value. But then there are some that are a little bit more aggressive on the income side. Things such as business development companies, or BDCs, and real estate investment trusts, or REITs. Now, these options do not have a par value, but it can certainly be argued that their underlying assets do have a par value. Annuities, of course, can also be categorized by risk and how they generate earnings. And that's why you have fixed annuities in the conservative side, and oftentimes we put indexed annuities in the more moderate category because the amount of interest isn't fixed or guaranteed. Why? Because indexed annuities typically pay interest based upon the performance of some market index, such as the S&P 500. So while this gives them more growth potential, it also increases the risk that if the market goes down, they might actually get zero interest. Now let's get to another one of your questions, this one from Donna in Tennessee. What happens if a company defaults on my corporate bond? Well, it really depends across the board. In some cases, if it's a totally unsecured bond, the investor might get almost nothing back, maybe 10 or 20 cents on a dollar. If it's a secured bond that's secured by assets of the company, then they might get 70 cents on a dollar. But either way, a bondholder will typically get back more than a stockholder if a company defaults on debt. Donna, great question. Thank you. And if you have a question, just email me right here at askdave@theretirementincomeStore.com. And now back to Jeff on some of these, as I call them, slightly sexier income options.
Well, you know, Dave, the bond market has done very well for corporate bondholders in the middle range of safety or a little bit below. Those yields have performed very well, and the values have gone up because of credit spread compression. If you're not a bondholder and you're looking to get back into corporate bonds, where everybody's fighting for them, by the way, they've been fighting for corporate bonds, you're going to pay a premium. And you're not going to get the same yield because of that compression. So it's worked on both sides of the equation, Dave.
Yeah, you're right. It makes it tougher if you're buying them now. The good news is because of that optimism that's occurred in the market, which has caused long-term interest rates to go up and caused U.S. government bonds to drop in value year to date, most corporate bonds have not dropped in value nearly as much. And as you said, some have actually gone up in value. But it's that same optimism that caused business development companies and real estate investment trusts to go up so far year to date, as well as high dividend-paying common stocks. But as you know, our next guest is probably not a big fan of these types of tools, especially dominated in US dollars, and that is Dr. Marc Faber. He's an economist and a market forecaster. He's also publisher of the Gloom, Boom, and Doom report, which is available at gloomboomdoom.com. That one always gets me in the teleprompter. Marc, thanks so much for being back with us on the Income Generation.
Well, thank you very much for having me on your program.
Of course.
Dr. Faber, I have this theory that the Fed has just gone all in with economic, monetary, fiscal stimulus from the congressional side, from the Fed side, to boost up the economy like it's never been boosted before so they can raise taxes at some point next year, assuming they maintain control of the House. How do you think President Biden's economic policies going forward could impact the markets and the economies?
Well, obviously, the markets are impacted by many different factors, but mostly at the present time by monetary factors. And there's still plenty of liquidity. And people are talking, following last week, about monetary tightening. Well, we have negative real interest rates. In other words, if you take the rate of inflation and the rate of deposit rates, or of the Fed fund rate, we haven't had this negative real interest rate since the 70s. And as you remember, in the 70s, we had accelerating commodity price inflation and wage inflation and so forth. So I think that to talk about monetary tightening at the present time is a very relative expression. And the statements that have come out of the Fed following this kind of hiccup in the market over the last 2 weeks was actually very benign in terms of tightening. They don't intend to increase rates until the end of next year at earliest. And they have plans about employment levels and so forth, which in my opinion would take a long time to be reached.
Well, true. That's Dr. Faber, let me interject for a minute. That's true. But what the Fed is doing is they're feeding this inflation monster, and fear has turned into reality, and things are getting more expensive. Supply lines were hurt. Demand is up. And so are we going to see inflation like we saw in the 70s? Is that possible?
Well, it's possible, maybe even higher. But I don't think it will be lasting. Let's put it this way. If you look at history of inflation, we always have bouts of inflation, and then the price level rises significantly in some cases, but then it moves sideways for a few years and then it goes up again. It's like a staircase going up. And my sense is that we are now in a period where a lot of prices will adjust on the upside, including wages. Whether it will help much is very questionable, in my view.
Yeah, so we're in one of those upward bouts right now, and as opposed to us being worried about the Fed acting too soon and causing a recession, this time the Fed might actually wait too long. But I'd like to change the conversation, because the purpose of our show today is we're talking about retirement income sources. So in this low interest rate environment, how do you tell people who are retired or close to retirement to generate income from their investments who need it?
Yes. I think what I would have told them already 50 years ago is you need to save some money every year and not to overspend. Happiness in life comes on many different levels. Overspending doesn't help. It actually makes people miserable because they have a tough time to repay their loans. So by saving constantly and by diversifying your investments, nobody's smart enough to be at the right time in the meme stocks, and then at another time in gold shares, and a third time in utilities, and then in bonds and so forth, and shift around his money all the time. I think disciplined investment and persistent investment and patient investment is crucial. Yeah. And I think in the market today, you have some hot stocks. Nobody knows what their values will be eventually. And then you have some value stocks. And I think the value stocks are reasonably priced.
Yeah. So I would agree. If it's in a time like this, you're going to be in the stock market, stick to value, try to get some yield. And that way if things go down before they go up, at least you got your dividend coming out. So Dr. Faber, thanks so much for being back with us here on The Income Generation. It's been our pleasure.
Thank you very much.
And coming up after the break, we'll talk about the income option that can work well And I think we just alluded to it thanks to Dr. Faber, if you have the right risk tolerance and want to stay in the stock market game. Plus, we'll talk to income specialist Joann Regan from Arizona. All that and more coming up.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to the Income Generation. I'm David Scranton, and thanks for tuning in today as we help you understand your retirement income options. And so far, we've talked about the most conservative options, as well as those that carry just a wee bit more risk. And now let's talk about one income-based option for staying in the stock market. You know, the investment options on the right are typically considered aggressive. Why? Because they carry the most risk. These include common stocks, mutual funds, speculative real estate, variable annuities. And these should look familiar because they are the tools that most people use to accumulate assets throughout their working lives. And that's because, you know, at that stage, they're growth-based strategies that make sense when you're in your growth and accumulation stage of life. However, once you get over the age of 50 or so, you begin transitioning from the growth stage to the income stage. And that's when a strategy focused on income can make more sense. But does that mean all the options in the aggressive category are out? Well, not necessarily. As I've explained before, if you want to stay in the stock market game after shifting your focus to income, you can do it. And the key lies in shifting your stock strategy from one geared toward capital gains to one geared toward dividends. Because when you own dividend-paying stocks, you get a share of the company's profit in the form of a quarterly dividend payment. And that's return in the form of income, which makes it an income strategy. But just be aware that investing for dividends can be more challenging than investing for growth, and that stocks are always considered riskier than individual bonds. And with that said, if you have the right risk tolerance, the proper dividend strategy can offer a much more practical way to invest in the stock market as you get closer to retirement. So now let's get to another one of your questions. Kim from Arkansas asks, I just read a book about dividend investing that makes it sound easy. Why isn't it? Kim, awesome question. It probably made it sound like you can just go ahead and buy a bunch of blue chip companies that pay 4, 5, even 6% dividends. And because they're bigger, they're blue chip, just go ahead and buy into those and you get your dividend. But there's a real concern there, because when you're buying higher dividend companies, you're getting companies that are at the mature stage of their life cycle. Because companies that are more in the growth stage of their corporate life cycle, they don't pay a lot of dividends. They want to reinvest those profits internally. And as you know, not all companies stay in the mature stage forever. Some of them get to the stage where they start to decline in terms of market share. And they cut dividends and stock price goes down. So the key is to find those companies that are at the beginning of the mature stage and that still have some legs left ahead of them for corporate growth. So again, Kim, thank you. And be sure to send me your retirement questions by emailing us at askdave@theretirementincomeStore.com. So Jeff, we got, corporate bonds, we got preferreds, BDCs, REITs, now common stocks.
Well, the same reasons why valuations are skyrocketing in every asset class. Corporate bonds, we have credit spread compression. There's a huge demand for them. Valuations in those bonds have gone up. Yields have come down. So it only helps people who own them, not people who want to buy them. The same thing is happening in every asset class, Dave, whether it's value stocks, growth stocks, commodity-based stocks. It doesn't matter what it is. Valuations are stretched.
Yeah. And of course, the Federal Reserve, of course, is a big part of that. But you're right. And that, and just to be clear, that credit spread compression that Jeff's talking about is really what caused a lot of corporate bonds to be down year to date by a lot less than government bonds. I said the 10-year U.S. government bond is probably down 7% year to date, depending upon, we record the show in advance, depending upon, as it actually runs. But the reality is that most corporate bonds are down a lot less and some are actually up. And you're right, that same optimism caused BDCs to be up in value, real estate investment trusts to be up in value, and even these high dividend common stocks that we're talking about now.
Well, part of it is the Fed's policy, their monetary and economic policy. They've created this huge speculative bubble. But the other side of the coin is, Dave, these companies have performed. They've exceeded their earnings. Their numbers look good. The economy is strong. So it's kind of like a double-fisted approach there on why things have risen so quickly.
Yeah, and things have recovered really quickly since the pandemic. And nobody knew when you shut down the economy what was going to happen. But I guess it just goes to prove that our economy here in the great United States of America is more resilient than we ever could have managed. At least it's confirmed that for us. And something I want to ask our next guest about, Jeff, and that is income specialist Joann Regan. She's president of Financial Security Group, a retirement income store located in Glendale, Arizona. Joann has been helping clients with tax, estate, and retirement planning now for over 2 decades. Joann, thanks so much for being back with us here on The Income Generation.
Well, Dave, thank you so much for having me. It's a great day to be talking about income, isn't it?
It always is, yep.
No doubt about that, Joann. But speaking of income, in your experience, do a lot of the people that you meet for the first time have a good understanding of their savings and investment options, or do you find that they're limited in scope?
I would have to say that it's kind of a mixed bag. I mean, I have some very sophisticated people that come in and they're very knowledgeable. And they're knowledgeable about what their investments are doing and their savings and so forth. And then I'll have the person that comes in that just absolutely has no idea. They've placed something in some sort of a product and it's been there for decades and they absolutely don't know what to do, how it's doing. They have no way to analyze it.
So what are some of the main points in that kind of a conversation you try to stress when educating maybe new clients that you're working with about investing for income and utilizing the income model?
Well, obviously, I have to explain to them what the income model is and how it works, and that when they are dependent on their investments for income, what they need to do and how that needs to apply to their specific situation. So obviously, the first thing I'm going to do is I'm going to analyze their income needs. And then I'm going to show them how they are not being able to do that with the portfolio or the investments that they currently have. And so I'm going to kind of guide them through the process, educate them, and get them to understand that they want to take income from their portfolio and not be taking out their principal.
So when you have that conversation, do you find that sometimes they get really surprised about the income that they can create? And what is most surprising that they've expressed to you?
I think that they don't, just because they don't understand what's going on and they don't understand how their portfolio works, that is a surprise to them, that maybe they're having to sell off assets in order to take that check that they want. And I tell them, you can reinvest this a little tiny bit differently. And then instead of taking out principal, you're taking out what that principal is actually generating so that your money's going to last you longer in your retirement.
What are people most surprised about when you explain the income model and they see the difference? And what are some of the shocking remarks they've shared with you in that regard?
Well, the most surprising thing that I find is people don't understand that when they have to sell off investments to take a check every month versus their investments are earning dividends or interest or something that's paying income, what a huge difference that's going to make to them, that they're not liquidating principal and they're actually going to be able to take income and be able to enjoy their life and their retirement like they had originally planned. So it's a big shock to them that there's a difference in the model and the way that they can do things.
So what happens when you get that person who typically it's the accountant or the engineer who mathematically projects out at rates of return that they should be okay to stay invested for growth and to sell shares, as you said, which is, I agree with you, is a no-no. When they've got all this math to back it up, and you've got to get through to them because it means really a successful retirement versus they're not having a successful retirement. How do you do that with that tougher nut to crack?
Well, I have an extremely huge accounting and tax background, and I'm an accountant, so I can relate to those people fairly easily. And when I'm talking to them, I have to give them numbers. I have to show them exactly what they're doing versus what the income model will do for them. And a lot of them see the light. Some of them don't. They're convinced that the way that they do it right, and obviously that's not going to work for them to be a client. But most of the people, I'm able to show the difference between the two models, and they totally are surprised by it and are eager to, try to adjust to that type of an income model.
Yeah, most people just don't understand the difference between taking an average rate of return versus having some great years, some bad years that may average the same, but it affects you adversely once you're retired. So big difference. Joann, thanks so much for being back with us as usual. We love having you here with us.
Well, I appreciate it. It is a pleasure to talk to both of you today.
And coming up, we'll talk to income specialist Anthony Saccaro from LA. We'll also talk about how to determine the retirement income options that might be right for you. All that and more coming up on The Income Generation. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, our free Retirement Income Kit is for you. It's chock full of information you need to know to get steady income during your retirement. Call 866-710-1749, online at theretirementincomestore.com.
Welcome back to The Income Generation. It's great to have you. I'm David Scranton, and today we're helping you understand your retirement income options. And so far we've covered most of them. But now let's talk about how the right advisor can help you determine which of these options actually work best for you. In my experience, the conservative and moderate tools we've discussed are typically the most appropriate for a majority of the money of investors in or nearing retirement. And that being said, there is no such thing as a one-size-fits-all income strategy, nor does an income specialist ever take that approach. The tools and strategies that he or she might use are often based specifically on your needs and your particular situation, taking into account a whole bunch of different factors, including your age, your assets, your retirement timeline, and yes, as we said, your goals. For example, if you're already retired with a very comfortable savings, a strategy built mainly around conservative contract-based tools and strategies might suit you. On the other hand, if you're planning to retire within 5 years, but are worried that you still haven't saved enough, in that case, the higher risk income strategy might just be right. And that means a plan that still gives you upside growth potential, but helps protect your investments from downside risk more effectively, most likely than your current growth-based strategy. So here's the main point. Your retirement income options are much more dynamic and much more diverse today than the old-fashioned tools available 30 or 40 years ago. Now let's take one final question from you. Todd from Maine says, how difficult is it to change my income strategy if my situation changes? Well, Todd, the answer is it's actually quite simple, and thanks for writing in. It's simple because, these things generally are liquid. Of course, you have to sell them at market value, so there might be some times that are more opportune versus less opportune to make a change. But yes, you can always make changes. You can make adjustments as you go along. As any good financial plan should have that type of flexibility built in. And once again, be sure to send me your retirement questions by emailing us at askdave@theretirementincomestore.com. And now let's bring back in Jeff Small.
So Dave, the one-size-fits-all approach doesn't work, but a lot of advisors use it just because they don't have the training or they haven't discovered enough of their own philosophies that really are correct for their client base and giving their customers what it is they really want versus force-feeding them. And I see the one-size-fits-all as a force-feeding to a client on what they should be doing with their money.
Well, that's a carryover of growth-based strategies. A lot of advisors, for CYA purposes, right, and we all know what CYA means, will give a client a risk tolerance questionnaire, and the client will answer a bunch of questions, and then they'll put the answers to those questions in a computer. It goes into an algorithm, and the algorithm spits out, based upon some probability weighted statistics, that the best option for you, Jeff, out of 6 portfolios is portfolio number 4. And, I don't even like that in the growth environment, although I understand how it could work, but it's obviously suicide in an income-based environment.
It really is. And what viewers and listeners need to really understand about that, Dave, because it's hard for a consumer investor to discern the difference in knowing whether they're getting something that's quality or not. But what you described is exactly what the banks and the big brokerages do. They have a cookie cutter approach. 7 different portfolios based on your questionnaire. Here's what you're going to get. So there's no customization. There's no sophistication. There's no correlation to identifying what your true lifestyle goals are and correlating that to your money.
Yeah, and goals are important because when you're in the accumulation phase, your goal is to get the most return, the most growth, so you have a bigger pile of money as you approach retirement. Okay, so that's one goal. Everybody's goal is pretty much the same, which is why the algorithms are kind of sort of okay in that environment. But you're right, when you go to retirement, everyone's retirement is different. Their goals are different. Their objectives are different. Some people might be buying vacation homes or boats or lump sum purchases, whereas others just need more income. So you're right, as with everything, like we always talk about, it starts with your goals.
It starts with your goals, and then it starts with how much income can you create from all of your resources? And are we going to have more income in retirement than our actual fixed expenses are, and how much surplus income there is? And then let's tie that off to what we want to accomplish going forward. And that's really the correct way to look at it, Dave.
Yeah. And Jeff, of course, as you know, our next guest, we both know him quite well. He'll have I'm sure, some great things to say also about goals and goal setting. He is an income specialist, and that is Anthony Saccaro. He's a lawyer, but as I always say, we won't hold that against him. But he's also the founder and president of Providence Financial and Insurance Services, a retirement income store located just outside of LA. And he's author of the new book, More Life Than Money, which is coming out shortly. Anthony, thanks so much for being back with us here on The Income Generation.
Thank you for having me.
Newly published author on deck, getting ready to be, right, Anthony? So it's been a tough year. How would you say most of your clients are feeling right now at the midpoint of 2021? Are they optimistic? Are they worried? Are they hopeful? Because the markets have been resilient.
You know, I feel like my clients actually have more common sense than the politicians. My clients know that this can't go on forever, and we're coming out of this. You get the sense that we're coming out of this euphoric period where the government's pumped, $5 trillion or whatever amount that is into the economy. That's boosted the stock market. Everyone except the politicians seem to know that this can't keep going on. And I find that most of my clients are actually nervous. It's that sixth sense within them, but they don't really know why. But I think they need to pay attention to it.
I have found the exact same thing down here in Florida. It's odd that California and Florida consumers are aligned in that sense, don't you think?
Yeah, Florida and California are very similar, but the reality is most of the times people out here in California are a little bit goofy to begin with. So when they start thinking that things might be, going in a bad direction, or they start getting worried, then I think the rest of the country should follow suit.
Well, you said something funny before, Anthony. You said your customers have more common sense than the politicians. I'm not going to touch that. We'll just chalk that up as a funny. But tell us what your outlook is for the next 12 months. You're going to see the Fed tapering. Are we going to see the economy stand on its own? Are we going to flatline like we did after October of 2014 when the stimulus ended? What do you see happening?
That's more of a difficult question today than it was even a year ago, I would say. The reality is it's very difficult because you've got so many competing forces. You still have this money that has been printed, that is in the economy, that is a big boost for the economy, and interest rates are still low. But the Fed has indicated that in a year or two, they might raise rates. Inflation is starting to creep up. That's not good for the stock market. My best guess is in the next 6 to 12 months, the market will stay at this level or even climb up a little higher. But then after that, I have no idea. All bets are off. It's probably going to be some choppy waters if I had to guess.
Well, it sure does feel like the mother of all asset bubbles, though. I mean, everything is skyrocketing from real estate to corporate bond prices to the stock market. Inflation, like you said, is starting to run rampant to a certain degree. So with not much more money being lent, and that's a scary proposition, Anthony, that means we're coming to the pinnacle and there's going to be a capitulation back down, a reversion to the mean at some point.
That's exactly right. The money's what's been leading us out of this recession. there's a big canyon right now, the Grand Canyon, if you will, between where the stock market is at record highs and where the economy is with still unemployment and very low levels. And the bottom line is this canyon is being filled with all the government's money. That's the only thing separating it. So if you quit putting the money in the canyon, which is what's going to be happening here soon, then the stock market has absolutely the possibility of retracing back to meet the economy, because these two things are supposed to be hand in hand, and right now they're not.
So bottom line then, your clients then aren't much different from Jeff's, aren't much different from mine. They're at the stage where they need to be making that shift from the G to the I, from growth to income. Bottom line, what are you telling them today as they prepare for retirement?
Well, I'm generally reducing the risk of most of my clients. Most of my clients have 30% or less of their money in equities at this point. And even if you do want to participate and have some growth, and even if you can afford to take the risk, when you look at the numbers of dividend-paying equities versus non-dividend-paying equities, there's really no comparison. I mean, over the last 50 years or so, they've returned 50% more, and there's been a third less volatility. If you look at the last 40 years and you look at the S&P 500 with dividends versus without dividends, the stocks with dividends are like they pay like 5 times more because of the compounding. So you can still get growth, but I would focus on dividends in the equities that you have, and it makes it safer and it reduces your volatility. So less stock and higher quality stock with dividends. I think that's the way to go for most of my clients.
And that's something I'm sure that people shortly will be able to learn more about by pre-ordering a copy of your new book, More Life Than Money. And you do that by going to morelifethanmoneybook.com. Anthony, thanks so much for being back with us.
Thank you for having me. Great to be here.
And thanks to all of you for joining me once again on The Income Generation. And thanks to Jeff Small and all our guests. We had a great time. Bottom line, if you're close to or you're in retirement and you're concerned about your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on The Income Generation. I'm David Scranton, and we'll see you next week.